Good afternoon, ladies and gentlemen, and welcome to part 3 of our Japanese candlesticks for novices to the experienced trader. Now today we're going to do a quick review on what we learned in the first 2 lessons. Then we're going to actually take some look at some charts, but we're more going to be concerned with looking at strategies on charts, and then I'm going to show you some easy ways that you can use all of this stuff that we've taught you about candlesticks, because today the computer systems do most of the work for us. So having to remember what a Koji is, having to remember what a Harami is, having to look for a bearish engulfing or a bullish engulfing is time consuming. But there are very easy ways, because all of that can be put into computer language and algorithms, and systems can scan for it for you. And I'm going to show you exactly how this can be done, and make it easy for you. It's when you see the pattern or it's emerging, it's important that you know what to do with it. And that's what the classes have been all about, is how to make the right decisions. Now remember, candlesticks are a form of charting developed by the Japanese rice traders. They've been around a long time. But some of the reasons that the terms are so odd is because they were developed by the Japanese a long, long time ago. So when we hear Marubozu, or we hear Harami, or we hear Doji, these are Japanese terms that have been around for thousands of years, but it's not important to remember all of their names. It's important to recognize the patterns and know what the patterns are trying to tell you. Now remember, each candlestick that appears on a chart, and it doesn't matter for our conversation whether you're using a 15-minute chart, a 1-hour chart, a 1-day chart. Doesn't make a difference, because that's part of your trading strategy. The patterns and the candlesticks still appear. So if you see a Harami and you're using a 1-hour candlestick, that's what's developed. If you're using a 15-minute candle, but you shouldn't be changing the charts to find something to make you trade. Okay? You should have your rules of the trade and how you establish your trade, which is completely up to you. But remember, time frames tie to the type of trading you're doing. If you're doing short-term day trading, you should be using shorter-term charts. If you're doing swing trading, you should be using 1-hour or 4-hour charts. If you're doing long-term investing, you should be using longer charts. But you shouldn't be trying to force something to happen by using or moving to different charts to try to get something to happen for you. Now remember, each candlestick covers the period of time that you've selected for your chart. So if it's a 1-hour chart, every hour a new candlestick appears. If it's a 15-minute chart, every 15 minutes a new candle appears. And this candle tells you the fight between the bulls and the bears. Now, the long parts on the top and the bottom of the candle are known as wicks or shadows. And then the colored in part of the candle is known as the body. And there are 4 points of data put on a candlestick. First, you would draw a line across at the open. You would draw a line across at the close. And again, if you're using a 15-minute chart, that's the beginning of the 15-minute period and the end of the 15-minute period. If you're using a 1-hour chart, it's the beginning of the 1 hour and the end of the 1 hour. If you're using a daily chart, it's the beginning of the day and the end of the day. Then you put a dot at the highest point that asset had reached during that particular time frame, and a dot to the lowest. You connect those highs and lows to the body, forming what's called the wick, and then you fill in the candlestick. Now, when candlesticks started out a zillion years ago, they were in black and white. Today, we use reds and greens, or all the new charts allow you to set your own colors. So if you like orange and pink, you can have orange and pink candles. As long as you know which color is bullish or which color is bearish, it's completely up to you. Now, you fill in the candlestick with the bearish color if you step down from the open to the close. If you stepped up from the open to the close, if you climbed up the ladder in that segment, it's a greenish candle or a bullish candle. And that's what makes up the individual candlesticks. Otherwise, it's pretty simple. Folks, somebody just wrote in they lost the sound. Okay, I can tell from my end if there's a sound problem. If there is a sound problem on your side, it is most likely your computer, your internet connection, your Wi-Fi. Okay. If you develop a sound problem, the best you can do is log out and log back in. Because there's nothing I can do to assist you. Even if you lose the screens, there's nothing I can do to assist you on a one-on-one basis. I know the guy who wrote and can't hear me. I already typed him a message. Okay. But I'm just telling everybody, so if you develop a sound problem or a view problem, you either need to type, hit your refresh button or log out and log back in again, okay? But if there's a large problem, I see it because I have all these monitors and these things that the software gives us. Okay. So, but thank you very much. I just wanted to let you all know. So we have our bullish and our bearish candles. Now, these candlesticks tell us the battle of the bulls and the bears. They tell us who is dominating the market and why the market is, or what is the story in the marketplace. There are basically 6 different stories. That's it. In number 1, we see the white, which is a bullish candle, and that tells you that the bulls dominated the session for most of the session and they remained in control. The black in number 2 is the exact opposite. The long black candlestick indicates that the bears controlled the ball for most of the game. Number 3 is the small candlesticks, and we're talking about the body of the candle. When you have a very small body, it tells you there's indecisiveness. And that's very, very important. When the wicks are of fairly even lengths, they're not too erratic. It just tells you there's complete indecisiveness in the market, and both the bulls and the bears are more or less sitting on the sidelines. In 4, you have it in bullish and bearish signals because it doesn't matter where the price ended up because the bodies move so little. Nobody really was in control. But at some point, the bears broke out, but they lost their momentum. And that's why you have that long candlestick down to where, or the long wick down to the bottom. 5 is just the opposite. The end of the game was totally indecisive. But at some point, the bulls gathered up a lot of momentum, but petered out, and we ended up with a very small candlestick. 6 said both of them were having these great big tug of war, pulling back and forth, back and forth, back and forth. But at the end, they all ended up back on the banks on the tug of war. And it's a very good way to look at these. If you look at it as a tug of war, you have 2 teams on either side of the river. Okay, who's pulling the hardest? Who's making the headway? Who pulled the other side in? The other side pulled out. And it really lets you know of who is controlling the markets. And that is very, very important because this will help you decide what the other signals that you're looking at mean. Because if the bulls are in domination, but you get a sell signal somewhere, you need to question that sell signal. Now, if there's indecisiveness or the bears peaked and then the bulls took it back, then you know maybe that sell signal is more valid. But don't get yourself stuck in candles in a psychological response to what you see groups of reds and greens. In most cases, this doesn't tell you anything. So long bodies or long shadows or long wicks, whichever you care to call them, tell you who was able to at least get a surge in the marketplace. But when they don't end up dominating, it tells you that they kind of petered out. Now we come to the first candlestick that actually tells us something about the market, and that's the Marubozu. It's on all the sheets that I gave you. A Marubozu is a very important signal. I use it a lot. It's very easy to recognize because it looks a little awkward. A Marubozu has no wicks, no shadows. That means the green Marubozu or the bullish Marubozu meant that the bulls dominated that entire trading session. The bears never got a breath in from the open all the way to the close. The bears never even were able to pull it down a wee bit, and the session closed with the bulls completely still in domination. In other words, at the end, they were able to pull up to the highest level, and they never eased back at all. The same is the opposite with the red or the bearish. Now this tells you something about what you should see the next movement, because the next movement, the bulls should remain in domination. Now you could get a indecisive candle, and that just sometimes means that the bulls are taking a breather because they're finished buying for a second, they're waiting to regroup, and especially when you're talking in small time frames. But it tells you they are in control. And you'll usually see the Marubozu appear in the middle of a trend. When it does, it tells you that trend is very strong and will continue in its uptrend. If it appears in a sideways action, it will tell you that the uptrend is about to begin. Exactly the opposite. If you see it in the middle of a downtrend, that tells you that downtrend is very, very strong. It's going to continue downward. If you see it coming out of congestion or sideways movement, it tells you that the market is about to move into a very strong downtrend, because that tells you those bulls or the bears have just run out and they're out of that gate running full hog forward. Then we have spinning tops. Spinning tops have a long upper shadow and a long lower shadow, but really a very small body. Okay, and that's why they're called spinning tops. They look like spinning tops. Okay, they represent indecisiveness in the market and a potential change or an interruption to a trend. But you can't look at them without looking in respect to where they sit in a trend, where they sit to the previous candle, and where they sit in the next candle. But it forewarned you. Then we have the most well-known and the most popular of them all, Doji. Okay. Dojis happen a lot. Dojis tell you the markets are totally confused. And a doji has no body. They can have a tiny, tiny little body because, when you're dealing with pips in a currency, you're dealing with 1,000 points. So it could pip up red or green or black or white, but in most cases it looks just like a cross. It can have long legs or long shadows up and down. It's the actual price ended up opening and closing virtually the same. And nobody was in control, and it tells you there might be a turning point. Now you have dojis with all types of shadows. And they also appear it's important to look where a doji appears in connection or after the previous trend. And they are trying to tell you something. Now, after an advance or a long white candle, a doji signals that the buying pressure may be diminishing, and the uptrend could be nearing a trend, nearing the end of a trend. Now, what's key is that a doji is neither the bears nor the bulls have gained control, and that the price has ended where it began. It's a sign of indecision in the market and could, in conjunction with other indicators, signal a change in the direction. Now, dojis appear quite often, but you always have to look at them in connection to where they appear. Candlesticks on themselves are not, you have lots of individual candles that tell you something, but they don't tell you something without looking at the previous candle, at the next candle, and their situation or where they're situated in a price movement. But when you can do that, they can very much help you make a decision. So we have long-legged dojis. We have, like I said, we have all kinds. You have the dragonfly and the gravestone. They're just still, the open and the close were exactly or virtually the same, and somebody made a run out the gates. Maybe, and it could have been just when the market opened, or when that time, somebody pushed the price down, but then they moved right back up, or it could have been somewhere in between in that time segment. Don't care what. It just means at the end of that time frame, the traders were exactly where they started from. Now, before turning to single and multiple candlestick patterns, there are a few guidelines we need to cover. Okay. Now that you have the basic idea of what candlesticks indicate with their bodies and wicks, let's cut our teeth on some simple, uncomplicated candlestick patterns. Now, These are fairly common and quite likely to appear before you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make the difference between winning and losing a trade. So these are positions. So we talked about an individual candlestick and what it looks like, what story. Then we have positions. This is where the candlestick is positioned in relationship to the previous candlestick. So in this case, we have what's called a star position. This is not necessarily a spinning top. It could be a doji. It's a position when the next candle appears like it is a candle, like it's a star above or below the previous price, and it looks like it's gapped away, okay, when in essence you can't have a gap, okay, because price moves, but it looks like it gapped away. It's called a star position. Okay. And you also have shooting stars, which look like stars falling from the heavens or shooting up from the ground. All of these are indicating something might be happening in the price. We have, and I'm trying to run, I'm sorry I'm not spending a great deal of time on these because we did in the first and the second class, and if I spend a lot of time on these, we'll never get past them. Okay, so we're running through them real fast. So we have the hammer and the hanging man, and these also have small bodies, but they have very long wicks. So you have a hanging man and a hammer. A hammer looks just like a hammer, and a hanging man is just the opposite and is flipped upside down and looks like somebody hanging. But when they appear on a chart, they are very strong positions. They tell you something very important. A hammer is found in a downtrend and signals a bullish reversal. The long lower wick shows a period in which sellers were in control, but the body shows buyers were coming back. From this, we can tell that there is strong buying by the bulls as the period of sell-off declines. The hanging man is exactly the opposite, because remember, there's for every one of in this direction, there's an opposite one in the opposite direction, because you have the markets moving up with an uptrend, and then you have the reverse when the markets are moving down. So there's no hard and fast rule about what color a hammer or a hanging man should be. The fact that they have a short body already means that there's indecision coming in the marketplace. However, a green hammer or a red hanging man are stronger indicators. So here in this chart, you can see the formation of the hammer. Body, long wick. Okay. It's signaling we were in a downtrend, and now it's reversing, moving to an uptrend. There's no guarantee. It's just indicating to you. Okay. When you see these patterns develop, okay. Now, in both cases, we want to see where the chart pattern, the candlestick pattern appeared in relationship to the trend, and also what it saw before, what it saw at that time, and then what it sees next. So in this case, what do we see here? We have a very, very strong bullish candle. It's not a Harami not a Marubozu, because look at how high up the high was. There was a lot of strength in that candle by the bulls. They were in complete, utter domination, but for some reason, they couldn't keep it as high as they made it. Now, when we get the hanging man next to it, that could tell us a couple things. It could tell us the trend was going to reverse, or it could just tell us the bulls wore themselves out in the last segment. Okay, they could be regrouping, but then what do we get right after that? Okay, we get almost a doji, okay, and total indecisiveness. This is telling you the bulls are scattered. Okay, somebody asks, is a hanging man only a hanging man if the body is short? No, a hanging man is only a hanging man if the body is long. Okay. This is a hanging man right here. Oh, I'm sorry, body, not wick. Okay. Now, From there, we go to my favorite, and that's a harami. Harami in Japanese means pregnant. Okay. There are some variations in how strict the interpretation is. I use the strictest definition. Okay. What you have with a harami is when you have a previous candle, regardless of whether it is white or black, the next candlestick, again, in this case, is, I'm sorry, it could be, is a small body. Doesn't have to be a small body. Doesn't matter at all what size the body is or what size the wicks are. What is important is harami, like I said, means pregnant. Means the entire next candle is within the confines of the body of the previous candle. Okay. Now, a lot of people said the wicks can be slightly outside. Okay, there's all kinds of interpretations. Okay, some say the body of the next candle doesn't have to be in the opposite color. I say my interpretation, and I am very strict in this, is when you see a harami, then you have a nice long body candle. Doesn't matter how long that body is. The next candle must entirely be contained within the body of the previous candle. For it to be a very definitive explanation is, I say, the next candle must be the opposite color of the previous candle. But again, it's up to interpretation. Okay. And the rule of thumb is a harami is one of the most common candlestick patterns you'll come across. So it's important to recognize it, to understand what it means, and to understand its limitation. Harami is a two-session reversal pattern, i.e. it's made up of two candlesticks and implies that the price is about to turn. Okay. It is indicated by a small body of the opposite color completely contained by the body of the previous session. It is not essential, and this is where I differ entirely, it is not essential for the two candles to be of opposite color, but this tends to give it make it a more reliable signal. Okay. I only take it when it's fully contained and an opposite. Now, it depends on what rules you want to use and how lax you want to be. But harami appears quite often, so therefore, you have to be able to see it and recognize it. Now, as you can see in this chart, or this example, it doesn't have to be a tiny little body. It can be a fairly large body. It's important to be able to see them and follow the rules. Now, somebody out here said, this is complex. Trading is complex. Making a trade decision is always complex because you're risking your money. Okay. But you'll see shortly that it's not so complex with today's computer systems. But you have to understand what these mean, and that's why I gave you the handouts. Once you recognize it, look, all of us are looking to interpret the markets. And if we understand the markets are all about price action, and price action is all based on the psychology of traders. And you need to know when to enter the market, when to exit the market, where to put stop losses and take profits so that your trades are as accurate as possible and you have the least risk possible and can make the most amount of pips possible. It is complex, okay? Because otherwise you're just virtually guessing. And when you guess, you lose your money. When you can understand the markets, and it's like anything, even when you go to learn to ride a bicycle the first time, you fall off a couple times. It's difficult. When I learned to ride a bike, we had, what would you call them, English racers, where you shifted gears. First gear, second gear, third gear on the handles. It was complicated. You fell off a couple times. Before you know it, I have friends who are out, riding bicycles up and down the street, and they're using 10 gears. It gets easy once you study it and you learn it. Now, you have bullish and bearish haramis. Okay. Now, because you can have very, very long candles. If you notice on the right-hand side here on the two charts, to me, this is an acceptable Harami. The entire previous candle is inside the body of the previous candle. When your rules are very strict, then you will get the precise interpretation. When this developed, as this did, with these strict rules, we had a very solid movement to an uptrend. In this case, we had a long bullish candle. We have a doji here. Okay. And somebody has tried to interpret this as a bearish Harami. It is not. There are other names for it, but it's not a bearish Harami. Because look at how far outside the wicks are. Because otherwise you can have Haramis right and left. But you had some other things to tell you what was happening in the marketplace. Okay, guys, somebody just wrote in, these three docs include all three series. No, these three documents control the bare basics of the most popular candlesticks. The internet will provide all of it for you. You can go search candlesticks and find it. Otherwise, I could write you a book. Okay, these are just what I gave you are the explanation for the top and the most important candlesticks. Okay, they're basic interpretations. Now, this is where you start out from. It's like going to Biology 101 and learning the basics, and then going on to Chemistry 101, then you go on to Organic Chemistry, then you go on to Advanced Chemistry, and each time you learn a little bit more important stuff. Now, I'll be blunt with you. A Harami doesn't always live up to all its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reality. The psychology behind a Harami is that a possible change in sentiment may be happening. Now, if you define your rules and make them very specific like I do, then it more likely tells you that it is definitely happening. But be aware of a Harami, watch for what they are telling you about the market sentiment, but don't have blind faith in them. So we talked about building candlesticks, understanding and reading the candle, the explanation for different shapes and sizes, the formation of candles, the position of candles. We talked about dojis, haramis, bulls versus bears, and we talked about hammers and hanging mans. So let's go on to some of the more complicated patterns. We already talked about most of the single candlestick patterns: Marubozu, spinning top, doji, hammer, hanging man, inverted hammer, shooting star. Gave them to you. Now, we're going to go to the bullish engulfing, bearish engulfing, bullish tweezers, and bearish tweezers. But I've got to pick up the pace because there is a lot to cover here. And today we're not going to get involved in blending. In fact, we're going to have another webinar down the road in what we call blending of candlesticks. And that's when several different patterns appear together or after each other and how you can add them together for their interpretation. Now, also somebody just asked me, where should we put our entry and stop loss and target points? Okay. This has nothing to do with learning to read candlesticks. That's about trading with candlesticks. And we also have another class coming up for you on that because there's all types. These are basic strategies. Okay. There are many different strategies of how you can use the previous candles to put your stop loss or your entry points in, whether you use 50% of the largest candle to the right. And these are strategies that people have, individual traders have developed over time. And they're all quite different. They're not the rules of Japanese candlesticks. Candlesticks are all of this, and then you apply them to your trading decisions. And we do have another class coming up that will be on, and you just watch for the advertisements, that will be on setting stop loss and take profit points with candles. But that's a lot more complex because each person or each strategy uses a different philosophy. And you have to then incorporate them into your trading decision. Now, bullish engulfing and bearish engulfing are important signals because they tell you where the markets are about to begin or about to change. Now, a bullish engulfing shows you that the next body, it's almost similar to a Harami in reverse. You have a candlestick. When the next body of the next candlestick fully covers the entire body of the previous candlestick and is in the opposite color, it is a bullish engulfing when it's in part of a downtrend. Now, there is some rules that the candlestick must be 50% bigger than the previous candlestick. Again, this is up to each person's own strategy or own interpretation. I believe that the next candlestick to be a very firm signal needs to be almost twice the size of the previous candle in the opposite color. So what we can see here is we're in a downtrend. We have a regular downtrend candle appear, nothing out of the ordinary about it. The next candle is over twice as big as the previous candle in the opposite color, and its body is twice as big as the previous body. And that is telling you that the bulls have taken back domination of the markets. Now, it's not telling you it's going to go into an uptrend. Okay, this slightly pushed the price up, it went back into, and there's all types of interpretations that you can figure if it goes less than 50% of the big candle, that then it will then move into the uptrend. But again, there's interpretations because it went into a period of consolidation. The downtrend was over, went into a period of consolidation, and then finally broke out into the uptrend. You have the exact reverse. When you're moving in an uptrend, you get the bearish engulfing. In this case, it moved down a little bit, went into a consolidation area, and then started the downtrend. But it means that the current trend that we were in has ended. Okay, so what's happened is the market has shifted from bearish to bullish. And these are engulfing. Now, tweezers happen not so often, but when they do, they're very, very important. Tweezers look exactly like a pair of tweezers. They are two candles that appear next to each other where their bodies are relatively the same size and the wicks are the same size and they don't have upper wicks, so they look like a tweezer. And they are telling you, and they have to be an opposite color. When they're an opposite color, they are a very precise signal that the trend is over and the market are moving to a new trend. Okay. You have bearish, which are exactly the opposite, flipped over. Okay. And then we go to morning star and evening star. Okay. I'm not going to spend much time on these. These are complex little signals. I don't believe in them at all. Okay. When they do appear, they are, and the explanation I'm not going to even give you, but they're supposed to remind you of a star coming out during the night, and okay. So it's a really weird explanation. But it means when you're in a downtrend, you have a solid downtrending candle, very bearish candle. Then you get a doji, and then it gives you the new candle in the opposite color. Okay. And what it's supposed to reflect is the dawning of a new trend after you have a star in between. Okay. So the first candle is a long red candle on an ongoing downtrend. This candle represents strong bullish bearish sentiment. The second candle is a very short body candle with either red or green. From here we go to the third candle, which is more than half the length of the first red candle. This represents a comparatively strong change in market sentiment. And we have the exact opposite in the opposite size trend, and that's called an evening star, indicating that a downtrend is ending. Then we go on to the triples. We have 3 white soldiers and 3 black crows. These are very important candles. because they tell you something very specific. Somebody just typed in, which is the best candle indicated pattern is changing. There's lots of them. But when you see 3 white soldiers, you've now moved from a downtrend to an uptrend. This is 3 candles, all green or bullish after in a downtrend. But if you notice, each candle steps up from the previous candle. And this is what's important. It's not it engulfs it, not it encompasses. Each segment moves from that high, upper high. So you have 3 steps. So it's like marching up forward. When you see that, that's telling you the old downtrend, and this appears in a downtrend. It tells you that downtrend is long over and we are now in an uptrend. We have the exact opposite of that called 3 black crows, and it tells you the same thing in the 3 crow movement. Then we have 3 inside up and 3 inside down. Basically, these patterns happen rarely, they're very important, but if you were just interpreting the story of a market, you would have interpreted this without even seeing the pattern. You had a downtrend. You had a solid, strong, bullish push, a bearish push. Then you had the bulls bounce back. Now, in the second candle, we're not exactly sure whether the bears just exhausted themselves and the bulls took a little bit of favor in the next segment or they were buying from the lows. But the third candle then gaps up and continues rising straight up from there. That's telling you now that the bulls have taken control back of the marketplace. The last candle is a tall green one. It's a big move because that tells you the bears have been completely wiped out. We have it in the exact opposite with an uptrend reversing to a downtrend. So let's move into action a little bit. Let's talk about how you might use these to trade with. Now remember, each candle of a candlestick chart is a reflection of market sentiment. So it is not just the standard patterns, but with a keen observation, you can master the art of trading by looking at charts without even remembering the names of the patterns. Okay. So let's go over and pull up some live charts here and take a look at what we would look at on the charts. And I'm going to take you over and also show you how you can easily scan all the markets and find these easily and quickly without doing any work on your own. So hold on, let me pop up the charts for you. Okay, so first, let's talk about how you can find the candles. Because today, now there are all types of apps you can buy. There are all types of things you can put onto your charts. But investing.com has made it really easy for you. They just launched this a couple months ago, not even 2 months ago, I don't think. And it's just a candlestick pattern recognizer. You can customize it all you want. Now, if you guys, well, actually everybody attending the webinar has already set up a login with investing.com. If you go click on the asset anywhere on the screen, so here we're going to go click on Forex, we'll click on the Euro US dollar, and it's going to open up a chart. Okay. Now, if we go up to where it says technical and go down to candlestick patterns, it's not telling you what to trade, it's simply telling you all of the 16 candles positions or candlestick patterns we talked about. When they develop, this is a computer to spot them for you. Okay. And it's putting them on the charts for you, and you can just simply scroll across the charts. But it gets a little bit easier from there. If you go pull up the asset you're interested in, because you have a login, it will memorize all of your customization once you've done this. Okay. So click under Customize, then pick the time frame you want. And so I use 30-minute time frame for most of everything. Do you want bullish or bearish? I leave it all. Patterns and indicators. I want both reversals and continuations, but I don't want lots of the low patterns. I want the high to medium patterns only. Okay. This is my choice. Click on Apply, and we've now set our default. Okay. Now, because the markets are closed this weekend, so we're not seeing much. But again, let's go back to a 1-hour chart. Maybe we'll get something that's comes from Friday. No. Oh, I know why, because we got high, medium. It's just since the market. So we can see that in a 1-hour time frame, we had an inverted hammer, and it was with the most current candles, which would have been Friday's closing of the markets and even in currency. Okay. And if you click on the body, it's going to show you exactly what developed. It's going to tell you the bullish reversal, what it's a low reliability, and it tells you the description we talked about. Okay. It's up here on your charts for you. So if we move this over to a 30-minute chart, okay, we'll be able to, no, we did it 1 hour chart. Okay. We'll be able to locate it on the charts, and it's all done for you. You don't have to spend your time searching them out. And this is, you can pick asset by asset by asset that you trade and watch them. Or you can go up here to technical indicators at the top. Okay, scroll when that pops open, go over to chart, go over to candlestick patterns. Come on, computer. Okay, and then you can customize it for all the assets you want to see and what levels you want to see and what charts you want to see, and just leave it there, and it'll continually feed them up as they appear there, and then you can go over and look at those assets. Okay, Christina asked, if all traders would rely on patterns, would the price movement change, or is it the volume simply too huge? First of all, the volume is simply too huge. But nobody relies on just patterns. See, this is part of building a trading strategy and a trading system. Okay, I might use Japanese candlesticks, and I might say I'm only going to use level 3 or most important candlesticks, but I'm going to use them in combination with MACD and RSI, and I'm looking at 1 hour charts. It's all part of a massive strategy. Making a trading plan and then a trading strategy is more than looking at candlesticks. But if you imagine, it's just like a trend line. If you can predict where the markets will act and react to, okay, and you get them right and everybody else gets them right, guess what? You can then figure out what to do. It's when you don't know where the action or reaction will be. So this is one easy way to find these. Now let's look at candlesticks on a chart. Okay, there are all different ways that you can incorporate candlesticks into your trading patterns. Okay, here are candlesticks, and candlesticks are very good for drawing trend lines, and they're incorporated with chart patterns. So here we have a trading a rectangle right here, and at this point we were predicting the price to bounce off of that channel and fall back down, and we would have used our candles to tell us when we might want to move into the marketplace. In this case, we're using triangles as well as candles in the body of the candles to give us our support lines, and then we're looking for exact patterns in these candlesticks, and you can see them appearing to help us determine when the market reversal should be taking place. So again, now if you're using TradingView charts, TradingView will also allow you to go to here, and you can scroll over under their scripts, okay, and we can find, okay, here we just click on that script, candle patterns identified, okay, and look at that. It just dropped every one of these onto our charts. So everywhere one of these has occurred, it's already on our chart. So we don't have to look for them as long as we understand what they mean. Now, in this case, what we did here is we're using this in, along with Fibonacci retracements. We looked at the candlesticks moving up. Each one of these candles, we noticed a pattern. We were looking at these in reaction to our Fibonacci levels. And then here we actually saw a bearish engulfing, and we would have traded the asset to go down. Okay, and this is what we would have used our candlesticks for in this case. Okay, here again, we're using candlesticks, and we're using them not necessarily our patterns, but we're looking at them to find our lows and our highs and our high lows to build into our trading system. Okay. So there are many ways that we can incorporate candlesticks. It's first you have to understand and decipher how the markets are moving and make sense of the markets. Okay. This comes way before making trading decisions. Okay. If you want to use candlesticks, they're a very good tool to use, but you have to study them. Now, once you do this and you can understand the story you're telling, you can then move on to the next step, and that's building it into a strategy to make trading decisions. But never should any single tool be used by itself. If somebody asks, with all due respect, sir, isn't logic behind Fibonacci retracements and aren't the levels is stupid? Nope. Fibonacci retracements are one of those things that you have to believe in blindly, like faith. Okay. I don't know why Fibonacci's react, okay, but you'll find when you put them on your charts, something happens continually at the 32, the 50, and the 61.8. So all they become are levels of support and resistance. Okay. They're simply telling you that you should expect a bounce off of this price, and if it doesn't bounce off of this price, it should move to that price. All you're trying to do with anything is nobody can predict the markets. Okay? If we could predict the markets, we'd all be rich. All we're trying to do is define our choices. And when you go to enter the market and you've made a trade, you need to know where to put your stop loss. Because the thing that happens is too many traders can't figure out the swings in the market and where to put their stop losses. So their decision for their trade was completely right, but they got stopped out of the market because they couldn't cover the swing of the market, or they put their stop loss too close, or they couldn't figure out where to take their take profit point, and they put their take profit. I have a friend who just said to me a couple of weeks ago, he said, you know what, I never seem to make more than 50 points. You know why? Because he's always putting his take profit point too quick. Okay, so he's making 50 points, and he misses the 200-point trade he could have had. So all we're trying to do, and whether we're using candlesticks, applying Fibonacci's, using MACD, is we're trying to understand what we can expect or where we can expect price action. In the entire time, we're trying to interpret market psychology. And we're trying to also stay in front of the big boys. You know, when Goldman Sachs dumps $1 billion into an asset, into the euro, or starts buying up, some of these assets, and I saw their trading sector, they'll dump in $50,000 in 1 hour. An hour later, they'll dump in $150,000. 3 hours later, they'll dump in $300,000. And 4 hours later, they'll dump in $1 million, and they keep dumping and they'll start the movement. We have to be able to see when that movement is happening. Okay, and that's what it's all about. Now, somebody asked me again, is this webinar recorded? Yes, it's recorded. Investing.com should send you a link to it, or about an hour or two from now, the link you had for the class today should be available. Or you can go to, on the documents that I gave you, there is a link to a YouTube channel. It will be there in a couple hours also. Or you can go and see previous and other webinars there. So thank you very much for joining us. Have an enjoyable Sunday, and watch for our 2 new classes coming up on figure out entry and exit points using candlesticks and strategies to incorporate candlesticks. But in the meantime, start reading them, interpreting them, start using the candlestick pattern indicator on investing.com, or use your TradeView charts and start looking and if you self-teach, if you watch them appear and then see the market reaction and you understand how the play is working, you'll get this pretty well down pat. So thank you very much, and we'll talk to you again real soon. Have a great weekend now. Bye.